This week, we'll take a look at the portfolio and talk about last week's action. A big announcement directly impacted two of our companies, so we'll react to that. Let's jump into it. Welcome to Get Invested, where we talk about money, discipline, and business strategy. In this series, I'm demonstrating how I build market-beating stock portfolios using a growth-focused mindset, starting with just $100. I invested $100 on July 1st of this year, and I'm continuing to invest another $100 each week, every Tuesday, here on YouTube. I share my trades for you to see, with a little bit of my thinking and rationale along the way. Direct links to the portfolio can be found in the video description below. If any of that sounds interesting to you, hit that like and subscribe button. It's how you tell the YouTube algorithm this is content worth sharing. Now let's take a look at the portfolio. Well, we're officially down for the first time in an episode. That's a real surprise coming off of last week, when we were actually up 11%. So let's take a closer look at what actually happened. As it stands, our portfolio is currently valued at $593.79, a negative gain of $5.09, and a negative return of 1.41%. Looking down at our individual slices, you can quickly see that a lot of the real damage happened in healthcare. Technology is doing well, up a respectable 9%. Our consumer stocks are still hovering right around 2%. And our more speculative automotive stocks, Tesla and NIO, are still down, but they're making their way back up from previous lows. So let's look at last week's view. And there it is. You can quickly see that just last week, we saw a drop of $40.95, a negative return of 6.45%. And when you look more closely, 18% of that, or in other words, $34 of the $40 loss, was in our healthcare stocks. So clearly something's going on in healthcare. But before we talk about that, you can probably notice a pattern in the other stocks in our portfolio. Overall, on average, they're all down about 1.5%. Typically, this is a sign of a bit of a market pullback. We bought into a lot of these stocks as they were bouncing off their all-time high. We're also going through earnings season at the moment, so it can't be that surprising that retail and institutional investors want to pull back some of their money, lock in some of the profits they earned in the run-up for most of these businesses, and then we know in a day, week, or month, they will all swing back in, and we'll see a lot of these come back up. But I just wanted to take this moment to point out, when you see negative returns across the board, that is usually the sign of a pullback and not a specific issue with one of your stocks. However, when you see a pullback of 20% in just one section of your portfolio, that is something worth diving into. So here's last week's view of our healthcare stocks. We got Teladoc Health, Livongo Health, and Quidel Corporation. Last week, Quidel Corporation posted positive earnings, but virus numbers are starting to level out, which could reduce the growth of revenue from a company that's focused on testing. It was probably a bit oversold when we bought it, but as always, we're on a 2 to 3 year time horizon, and I'm confident this one will grow back to positive territory. As for Livongo and Teladoc Health, last week we invested $60 into Livongo Health. I'm really bullish on this company. Well, it turns out I'm not the only one. A few days after we made our investment, Teladoc, our largest healthcare holding, announced it would be merging with Livongo. That's right. The telehealth provider is now absorbing the healthcare application platform to form a massive Amazon-like company in the healthcare space. Surprisingly, that good news actually triggered a sell-off of both companies. Teladoc and Livongo have been two of the hottest companies for the last quarter. And now that we hear they're merging, I think other investors got spooked by the sudden news and got out of the stock since they believe the growth story may stall while the companies sort out the operational logistics behind these kind of mergers. Anyone who's been through this before knows it's hard to keep up growth while blending different corporate cultures. I think this is what triggered the sharp decline in price. So what does this mean for us as Teladoc and Livongo shareholders? Well, at some point in the fourth quarter when the merger is completed, our shares of Livongo will automatically be converted into 0.592 shares of Teladoc plus $11.33 in cash, which will be distributed to us kind of like a dividend. Until then, the two stocks will start trading in tandem with the future priced into each one. So if you invest in Teladoc, it's the same as investing in the Livongo. If you invest in Livongo, it's the same as investing into Teladoc, except knowing that eventually you'll get about knowing that you're getting about half a share plus $11 back. But enough talking about healthcare right now. Let's just look at the overall portfolio performance so far. So here's our overall portfolio performance charted each week, benchmarked against the Dow and the NASDAQ. You can clearly see the tech sell-off happening as the NASDAQ starts trending closer to the Dow. But you can also see the sharp dip we're experiencing due to the healthcare news we just covered. The last few weeks have been really volatile for our portfolio. That volatility is not as bad when we look at it in a bigger context, though. And I hope this channel gives new investors a chance to see this kind of volatility so they know what they could be getting themselves into. Sure, $40 in value was wiped out last week, but that was mostly from our $35 in gains. Overall, we're only negative about $5. There's still some turbulence up here with high-flying growth stocks, but it's not the kind of turbulence that'll wipe out your entire portfolio. It's the kind of turbulence that attacks your gains. And when faced with down moments like this, we look to our overall strategy and we take corrective action, just like we did 2 weeks ago, which netted us those $35 in gains. We'll do that same thing this week. And for that reason, it's a perfect time to talk about our upcoming trades. Looking at our total portfolio performance, we see the dip in healthcare that we've covered, and we see that our automotive speculative stocks, Tesla and NIO, are down about 2%. When we look a bit closer at those, NIO has actually rallied pretty well. There was a point where they were down 24%. NIO is now actually up 17%. Meanwhile, Tesla is down almost 11%. Now, we bought into Tesla right around their earnings period. I'm not surprised that stock has cooled off a bit. It was probably oversold when we bought in. But I think now is actually a great opportunity to dollar cost average our way into Tesla a bit and into this new Teladoc-Livongo merger. So for this week, our investments are going to be into both of those companies. So we'll be buying $50 into the Livongo-Teladoc merger. I chose to invest in Livongo simply because I like the idea of getting the $11 out as a dividend once the sale completes. We could have bought into Teladoc and just got more shares of the company. We'll also be putting $25 into Cadell. I still believe testing will be a high growth area for the next few years, even if we do come out with a vaccine in the near term. And we'll put another $26 in Tesla, still very bullish on this auto manufacturer and energy storage company. So that's another $100 invested. We'll check in next week and see how these companies do. If you found this video interesting, hit the like button. Also, feel free to share your thoughts in the comments. If you want to join us on this investing adventure, hit the subscribe button. We'd love to have you. Links to this episode's portfolio are in the description below. And if you want to get notified each time we add a new video or new stocks, make sure to hit that notification bell. Thanks a lot. Have a good week. Stay safe and get invested.